Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So just a week or two ago, Charlie Munger sat down and did a Zoom video call and sort of Q&A session with CalTech. And at 96 years young, Charlie Munger is still as sharp as ever. And in this video, I want to pick up on one of the questions that was presented to Charlie Munger, and Charlie Munger gave a very quick and kind of snappy answer to. And that was basically all about his expected returns moving forward for stocks. And as you might know, on this channel, I don't typically like to get into sort of macro level stuff, but I think Charlie Munger's response was really interesting, and I sort of concur with many of the things he was saying. So want to play that short clip for you right after this intro and then get into some of the finer details of what Charlie Munger was talking about here.
Degree of science in 1975 asked, do you expect the next 10 years to have lower returns in the equity markets than the last 10? He doesn't give us an idea why.
The answer is yes.
And could you give us a hint as to why that might come to pass?
Yes, because so many people are in it and the frenzy is so great and the systems of management, the reward systems are so foolish that I don't think it's going to work at all. I think the returns will go down, yes. In real terms, the returns will be lower.
Now, in that short clip from Charlie Munger, he very concisely gave us at least about 4 reasons that he expects the returns from stocks moving forward to be lower than they have been in the previous decade. Now, those 4 reasons were the number of people in it, the frenzy that's so great, foolish management incentives, and he sort of snuck in at the end that he expects returns to be lower, but the way he actually phrased it was he said real returns would be lower moving forward. So I want to kind of dig into that particular point as well, and I'm also going to kind of tack a 5th one on the end there from myself, which is basically all around interest rates. So there will be timestamps right along the bottom of the video if you just kind of want to skip forward to any one of those parts of the video, but for now let's get straight into it, and I hope you enjoy. Now, the first point that Charlie Munger brought up here was simply the number of people investing in stocks at the moment. And he sort of mentioned this in the past as well, particularly as it relates to value investing and individual investors trying to pick individual stocks in an effort to sort of outperform the market. And he sort of relates it back to his own time when he first got started investing. Now, at that time, he said that the competition was minimal and any people that were sort of in the finance and investing space, frankly, weren't all that intelligent. And in recent years, it's attracted a whole bunch more people and a whole bunch of really smart people. And that just creates more competition in terms of finding opportunities. Now, with Charlie Munger's investing strategy, he is always looking to buy things for below their intrinsic value. Sure, he kind of converted Warren Buffett across to this wonderful business at a fair price kind of mentality as opposed to a fair business at a wonderful price. But still, price is very important, and really value investors who are trying to outperform the market over time are really looking for heavily mispriced opportunities, misunderstood companies, small companies that maybe other people just aren't looking at. And the more people that are kind of in this space hunting through these opportunities and sort of turning over rocks, then the lower the chances are for any one individual trying to go out and find a basket of heavily undervalued securities. Now, the second thing that Charlie mentioned, which are going to drive lower stock returns moving forward, is the frenzy being great. And I'm sure that many of you have seen this. I've seen a lot of people describe the stock market at the moment as very frothy, kind of bubbly, and not necessarily predicting a massive crash or anything like that, but just sort of trying to say that there are certain pockets, at least in the stock market, where valuations are at least getting stretched, if not getting, egregiously overvalued in many cases. And there's a huge amount of examples of this, particularly with early stage companies. Now, a lot of new people are in the stock market this year. A lot of people are investing for the first time in 2020, and a lot of those people get drawn towards these really cool stocks, towards businesses doing new things, innovating, growing really fast. And in my opinion, that has been both a good thing and a bad thing. The great thing is it's getting a lot of people started investing, and typically starting investing a lot younger than they might have otherwise been able to. But the bad thing is that a lot of them really aren't focusing on the core drivers of what makes a good investment. We have talked many times on this channel about the differences between a good investment and a good business, and those not necessarily always being the same thing. And this sort of frenzy type action with many stocks is almost certainly going to reduce the returns moving forward. One of the things that I spoke about in the previous video on this channel around Warren Buffett and some of the mistakes that he's made from investing was just overpaying for a business. And a company I always like to use with this example is a business like Microsoft. It's a company that has done really well over an extended period of time. It's grown its revenues, it's grown its earnings, it's become a larger and more valuable business, but the investors for a long period of time didn't do all that well. They overpaid for the business back in 1999, 2000 kind of time, and they basically had to sit there and watch the business do extremely well for sort of 10 or 15 years, while the stock basically didn't do anything, and it took them sort of a 15-year period, or at least very close to it, until they were able to break even on their investment. So there's a lot of pockets of the stock market at the moment that I think are probably in a pretty similar situation. There's some really great businesses out there doing incredible things, but whether the returns will actually be good is an entirely different question. Now, Charlie's third point here was around foolish incentive programs for management teams. Now, this again is kind of a topic that I covered in my previous video on some of Warren Buffett's investing mistakes and the categories that those investment mistakes tend to fall into. And one of the things that he also spoke about was management. And I kind of talked through some of the issues that go on with management incentives. Now, when you've got someone running a business for you that you are invested in, ideally you want your incentives to be aligned. You want the stock price to go up as an investor, and you want a CEO or a CFO or sort of an overall management team to be incentivized for the exact same things to happen, for you to get good returns as a shareholder, whether that be through stock price appreciation or whether it be through dividends or some other form of kind of return as a shareholder. And don't get me wrong, there are many great businesses with many great managers, but there are a large number out there where that's simply not the case. Maybe they are really good business people and maybe they're great people in general, but the incentives simply aren't in place for these management teams oftentimes to execute on things that would grow the wealth of their shareholders. Now, I want to give you a couple of examples quickly and then kind of talk you through a couple of examples of incentive structures that actually do work quite well, which Warren Buffett has actually implemented within Berkshire Hathaway. Now, there's basically two things that jump out at me as poor management incentives generally. The first one is revenue growth. Although revenue growth is really important, it can incentivize people to do some dumb stuff. It might cause them to spend a whole bunch of money on things that will grow the revenue, but they don't grow the revenue anywhere near enough to justify spending all that money. It's easy to throw money at things like marketing or acquiring businesses at exorbitant prices, those sorts of things. And the other thing that often comes to mind is share buybacks just kind of happening regardless of price as a way to get the stock price up in the short term as well. Now, really good management incentives align with the interests of shareholders, and a way that Warren Buffett has done this with some of his subsidiaries at Berkshire Hathaway is incentivizing people on the things that matter for shareholders. Something like incentivizing management teams on return on equity or return on invested capital. Now, if you take the return on invested capital example, there are basically two ways that a management team can increase their return on invested capital. One, they can increase the return. In other words, the business becomes more profitable, or two, they can reduce the capital. In other words, they can return unnecessary money that's kind of within the business to Warren Buffett at headquarters of Berkshire Hathaway. And setting up that structure really stops the management teams from doing nefarious things. It really keeps them kind of in line and doing things that are entirely in the interest of shareholders. Now, that definitely doesn't work for every business with this return on equity or return on invested capital type metric. And Buffett has said many times that this needs to be really aligned with the type of business that you might be in. Now, let's take a commodity company, for example. Commodity businesses have notoriously low returns on equity and returns on invested capital because oftentimes you are selling an identical product to all of your competitors. That's kind of the definition of a commodity. And oftentimes you're also in a business where prices are very cyclical and you don't necessarily have a lot of control on your year-to-year profitability. So instead, Buffett helps his managers to focus on the things they can control. If you're in a commodity business, that might be something like your cost of production. Now, in any kind of commodity businesses, there's basically two main things you should look at that drive profitability. One is the price you get paid, and second is how much it costs you to produce that. So if you're a dairy farmer here in New Zealand, for example, and you sell kilograms of milk solids, there's really two things that are going to drive profitability. How many kilos of milk solids can you sell and at what price, and how much does it cost you to produce that kilo of milk solids. Now, the price you can't really control in terms of what you sell that milk to, each year, but the cost of production is something that you really can control, and that's the way that Warren Buffett incentivizes his more commodity style business managers. Now, the fourth thing that Charlie Munger kind of just snuck in at the end here was he mentioned that he expected real returns to be lower in the stock market moving forward. He didn't necessarily just say returns or nominal returns or anything like that. So I want to just talk on that briefly. Now, basically, real returns is the idea of instead of looking at, how much of a percentage gain you make in a typical year, let's say you invest $1,000 and it goes up to $1,100, that's a 10% gain. Rather, he looks at things in terms of purchasing power, or he adjusts them for inflation. So, for example, if you invest that $1,000 and it goes up 10%, now you have $1,100, but all of the goods and services sort of around you that you want to go and use that $1,100 to, purchase those goods and services, if the price of those has gone up, say, 2% within that same time frame, your real return is only 8%. You've had an investment that's gone up 10%, but everything is now 2% more expensive, so you now only have 8% more purchasing power. So that's kind of just something that Charlie snuck in at the end. Potentially he sees nominal returns, just focusing on that 10% kind of percentage gain being good, but we may have a lot of inflation, and that's kind of a macro thing that a bunch of people have been saying lately, but we'll kind of just have to wait and see how that plays out. Now, the fifth and final thing I want to mention here is not one that comes from Charlie Munger, it's actually one that comes from me. And it's kind of a thing that I've spent a lot of time thinking about lately, and I've shared a little bit here and there kind of on the channel, but I want to get into it in a bit more detail. And that's basically this idea of really low interest rates, meaning lower returns in the future as well. And this comes down to a pretty kind of basic idea. Now, anytime that you value a particular asset, whether that is a piece of real estate or a business in the stock market, or a private business, or whatever it might be, basically you're always comparing the return that you can get out of that asset from your next best alternative. And often you're even comparing it to the safest alternative. And the safest alternative for many people has been either buying bonds or just putting that money in a bank account. And in the past, you were able to get reasonable returns by doing that, by just putting your money into safe investments. So for stocks and kind of riskier assets to look attractive, you had to be able to see a return that was much greater than you would be getting in these sort of risk-free assets. Or else it simply just didn't make sense to put that money into something risky without getting that extra return. And if you take that out into sort of a real world example in terms of, say, buying a business, it meant that if you could get 5 or 6 or 7% even just sitting in a bank account when interest rates were much higher, for you to go out and buy a business, you would probably be expecting something like 10 or 12 or 15%. Now, if you go out and look at, say, a stable business that earns $100,000 a year, for you to get a 10% return, you would pay about 10 times that amount. You would pay about $1 million to buy that business, and that would get you your 10% return. If you wanted a higher return, you would pay a lower price again. Maybe you'd pay $700,000 or $800,000 for that $100,000 of cash flow if you wanted a higher return, because you felt that that's what was necessary because you had this risk-free alternative, which was still producing something pretty good. Now, what's happened though over the past couple of decades is you've gotten these assets which were priced, relative to these higher interest rates. Let's say you've got this hypothetical business that trades at 10 times earnings, has stable earnings, and just chugs away at a 10% kind of return every single year. If you take that business into a lower interest rate world where it's still producing all that cash flow, basically the value of the business is going to go up and up and up and up, even though it's not doing anything better. And that's simply because your alternatives in terms of lower risk investments are looking less attractive, which means that a business earning 10% a year looks more attractive, and it means the price goes up and it's no longer earning 10% a year. And we've run that process really aggressively over the past decade or two, and in my mind it's just kind of squeezed a lot of the juice out of these business returns. If you were able to buy a lot of assets when interest rates were high, those assets have just gone up and up and up and up as interest rates have come down. And now we're at a point where, interest rates can go negative, but realistically, they're probably not going to go another 5 or 10 percentage points lower and have sort of the second squeeze of extra asset price inflation. I think we're probably towards the end of how much we can push that one. And I think that kind of squeezing of the juice out of this interest rate stuff has really explained a lot of the returns over the past decade. And we simply don't have that lever to pull moving forward. So those were some absolutely massive nuggets of wisdom in a very short clip there from Charlie Munger, plus a little bit from myself kind of added on the end there. So I do hope you enjoyed. I'd be keen to hear your thoughts on future returns from stocks down in the comments below as well. Always interested in reading that stuff. But that's all from me today, and I will see you in the next one. Cheers.